Welcome, my dear wonderful students, to this online learning platform. I'm Julius. Today we are going to talk about Unit 5, which is financial statements. Unit 5, which is financial statements. So as you can check on your monitor, so our lesson 1 that we are going to begin with under this unit, it is Introduction to Financial Statements. Introduction to Financial Statements. What do I expect you, my dear learners, at the end of this lesson? I expect you to be able to define financial statements. I expect you to explain their types, and then explain the importance of financial statements. So at the end of this lesson, those 3 important objectives should be achieved. Define financial statements, explain their types, and then be able to justify why financial statements should be prepared, why it is significant, why it is vital to prepare financial statements. So please pay attention, then we go on very well. So what are financial statements? What are financial statements? We are going to look at financial statements. Financial statements. So what are these financial statements? How can you explain them? The word financial comes from the word finance. So financial statements, these are financial reports which are prepared at the end of a given trading period to show the performance of a company or to show its position. So if you can check from your monitor, we can read together. Financial statements are reports that convey business activities and the financial performance of the company. So these business activities, these are trading activities which involve buying and selling of goods with the name of making profits. With these business activities, it involves buying goods. After buying them, you sell them. And in that process of buying and selling, or production, distribution and selling of goods, it involves other activities that we shall see. So financial statements are also reports prepared by a company's management to present the financial performance and position at the end of a financial year. So they are financial reports. Why do we say that they are financial reports? Why are they financial reports? They are reporting financial performance, financial position of a business at the end of a given trading period. And therefore, from the reports given, the business owners, different stakeholders, and in this case, business owners, can be able to make right decisions regarding the company or regarding the business. They can be able to predict and assess the future of the company, of the business, whether maybe the future is promising, or lay strategies on how the business's performance can be enhanced, how it can be enhanced so that the business can make profits. It can make decisions like, how can I reduce costs of production? How can I reduce expenses such that next year or next month or in the next 6 months, I make profits? So based on this report, because it reports what happened or what the business did in a given trading period. So they are financial reports, reporting financial position, financial performance of the business. So we have different types. We have types of financial statements. Types of financial statements. What are they? What are the types of financial statements? So if we move, we have the statement of financial performance as type number 1. Statement of financial performance. Statement of financial performance, or this statement of financial performance, it can be called an income statement. An income statement. An income statement. It can be called an income statement. And then some call it profit and loss statement. Profit. It has different names. Profit and loss statement. Profit and loss statement. Oh, it can be, it is statement of financial performance. It can be called an income statement. Some people call it profit and loss statement, or trading profit and loss account. Trading profit and loss account. And loss account. So all these names, they mean one thing: an income statement, profit and loss statement, trading profit and loss account, or what we call the statement of financial performance. So what is this now? So if we read together from your screen, you can check. Statement of financial performance. This reports the company's financial performance in terms of net profit or net loss over a given period. So in this, we are in a position to know, has the business made a net profit, or the business has made a net loss? So we must, or it reports this. And therefore, there are things that must be done for us to be in a position to identify whether the business made net profit or net loss. Whether the business made a net profit or a net loss. So the income statement, we shall find that it contains two accounts. It contains the trading account. It entails the trading account. And again, we shall have that it has the profit and loss account. Profit and loss account. So the two, when you combine the two, you form an income statement. So that is type number one. So starting away, right away, buying goods, selling them, so you subtract, so whatever, in those processes, then we come to finally net profit. We shall see the formula that we shall use. We shall see the preparation. Then in this case, this will be the statement of financial performance, showing how the business has performed in a given trading period in terms of net profit or net loss. Have you gained or you have lost? Are expenses more or they are less? If they are more, how can I reduce them? Very important, please. You must note that. Then we have the statement of financial position. The statement of financial position, or what we call the balance sheet. So type number two, the statement number two, statement of financial position. Statement of financial position. So the statement of financial position, it is the same as the balance sheet. We call it the balance sheet. Why do we say it is a balance sheet? It should balance. It is a financial report that represents majorly three items. It represents majorly three items. So its constituents, one is, it represents what we call assets. It represents assets. It represents liabilities. It represents liabilities. Then it represents what we call owner's equity. It represents owner's equity, or what we call capital. Or what we call capital. So these three items are shown, are portrayed, are conveyed in the statement of financial position. So a balance sheet, therefore, is a financial statement that shows the financial position of the business. or it is a financial statement that portrays or that shows, that represents a business's assets, liabilities, and owner's equity at the end of a given trading period. So this will help you to know how your business stands, how your company stands in terms of assets, liabilities, and owner's equity. So with assets, these are possessions of the business that are used in the production of goods and services. They have monetary value. They have monetary value, and they are used in production of goods and services. So with assets, we shall see these in details. We have fixed assets, so non-current assets, and we have current what? We have current assets. Fixed assets, we have current assets. Then when it comes to liabilities also, we shall find that under liabilities, we have two major categories. We have long-term liabilities, and we have current liabilities. With long-term liabilities, these are financial obligations of the business that it must settle a long period of time. Like bank loans, debentures, those are put under long-term liabilities. Current liabilities, these are paid in a short period of time. For example, sundry creditors or trade payables, what you call accounts payables. Bank overdraft, short-term loan that is less than a year. Talk about unpaid expenses and prepaid income. All those ones are put under liabilities, under current liabilities. Then we have owner's equity. With owner's equity, we are looking at the amount of resources, both physical and financial resources, that are invested in the business by the owner, owner's equity. So this balance sheet, it balances on an equation that assets in the business should be equal to capital plus liabilities. But you may find that your assets are equal to liabilities. That is in case you had no any starting capital. So the employed capital or just borrowed, like borrowed capital. The employed resources were all borrowed. Assets are equal to liabilities in that case, or assets is equal to capital. So you have to understand this very well. So on this equation, the balance sheet balances assets equaling to capital plus liabilities. So that is the statement of financial position, which represents three major items: assets, liabilities, and owner's equity. Then we have financial statement number 3, which is the cash flow statement. The cash flow statement. The cash flow statement. So what is a cash flow statement? What does this one deal with? So the cash flow statement is a financial statement that shows where the business gets cash and how that cash is spent. In other words, it shows the sources of cash, what we call cash inflows, and it has to portray information on cash outflows. Cash inflows and cash outflows. Very important. Very, very important. So with these cash inflows and cash outflows, at the end of it all, you have to balance the two. Cash inflows and cash outflows. Are my cash inflows greater than cash outflows? If they are greater, then we shall have what we call a surplus. The net cash position, here we have a surplus. But now if cash outflows are greater than cash inflows, then we have a deficit. And then if the cash inflows are equal to cash outflows, then we have an equilibrium. So we have to know that. So a cash flow statement majorly represents the cash inflows or sources of cash by the business and how that cash is spent. Very, 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 very important. Very important. Then we have number 4. Type number 4, what we call the statement of changes in owner's equity. or statement of owner's equity. As simple as that. Statement of owner's equity. Statement of owner's equity. We have already said that owner's equity, it is capital. And therefore, what does this deal with? You can check. So this is a financial statement that explains variations in the capital account. So when you say variations, these are changes. Number 4, it is statement of changes in owner's equity or statement of owner's equity, as simply as that. So now what does this one deal with? If you read from our screen, you can check. It is a financial statement that explains variations in the capital account. Variations, when you talk about variations, these are changes. If we talk about variations, these are changes. And what are these changes? These take place in the capital account. These variations may be additions, like the introduction of new capital into the business. You started with some capital, so it shows the beginning capital, Then, if you add more capital, or if you made a profit, any introduction of any capital, it will be an addition. Then through or throughout the trading period, in the due course, you made a profit. So that profit must be added. Maybe you added more profit. Then you did what you call drawings of cash. You drew out some cash for private use. So this is now a subtraction. Maybe there was a net loss made. There is a loss that was made. So all these ones are variations, are changes that may take place in the statement of owner's equity. So these affect the capital account. And therefore these changes are shown in the statement of owner's equity or statement of changes in owner's equity. So, and this finally, you have to see what is your ending capital. What is your ending capital? Beginning capital, add any addition to capital account, like maybe donations given by some of your friends to add more. The net profits made, add, then take away the drawings of cash, take away the net loss. Then from there, after looking at this, the statement of changes in owner's equity, then we want to justify, is it important to prepare financial statements? So importance of financial statements. Importance of financial statements. Importance of financial statements. So why is it important? Importance of financial statements. Why is it important to prepare financial statements? This is the significance. Why is it vital? What is the essence? So one, they help management to understand. You can check. They help management to understand the position, progress, and prospects of a business. The position of the business will be made through how you will look at your balance sheet and be able to know that. Look at the progress. Are you making, if this period you made a net profit of 500,000, then in the next period 1 million, in the next period 2 million, so at least the business is progressing. Very wonderful on that. It is progressing. Then number 2, they help shareholders to know the efficiency and effectiveness of the management of the company. If the company employed the management, people in the leadership, so through these financial reports, by looking at the business is making a net profit, huge net profits, the business or the company's assets are more than their liabilities, then they will know that these people are working very well. They are very efficient, they are very effective in the management. That's why the business is advancing through that. But if there is a persistent decrease in the net profit made by the business, then that would be a problem. Maybe the management is becoming inefficient. They help to know about liquidity. You can check number 3 to know about liquidity, profitability, and long-term solvency position of a company. So with liquidity, that is how is the ease with which assets can be turned into cash, liquidity. So are you in a good financial position to pay the liabilities using your assets? So we have liquidity ratios, which we shall talk about here, the liquidity ratios, like the current asset ratio or the current ratio. Even we have the cash ratio, we have the acid test ratio. Those are all liquidity ratios. We also have profitability ratios, the ability of the business to generate profits from investment made, like the margin ratio or the profit margin, which measures the ability of a business which measures how much gross profit that is generated from each unit sold. So very, very, very important. They help investors, you can check, to know the financial position of the business and decide if to invest in it or not. So these investors, they are one of the users of these financial statements. Investors, they want to know before they invest their money, how is the business performing? Is the business good? Is it performing very well? Such that they get attracted and they invest, they put in their capital, they inject in their capital into the business. If it is making more profits, it is promising. If its assets, the financial position is good, then they will be attracted to invest more money in the business, So remember, before I wind up this lesson, my dear learners, our objective, explaining what financial statements are, explaining the types. We have looked at 4 major types: the income statement, the balance sheet, the statement of changes in owner's equity, and the cash flow statement, and the importance of preparing these financial statements. So before I wind up, there's this simple assignment which we shall work out. Explain different types of financial statements. You own a company that deals with the manufacture of plastics. Do you think it's vital to prepare financial statements? Please go and work out this. Then we shall go through this assignment together next time. Thank you for listening and learning. We meet next time. Bye-bye.